It took me years to learn to trade, and today I want to give you information that I wish I had at the start. Things that would have saved me years of work, millions of dollars of mistakes, and watch until the end because every idea I share is going to build onto the next one. The whole video is going to be self-contained, and by the end of this, I want you to not have to spend any more time on technical analysis. One video that doesn't just say this is the only one you need, but could just be the only video that you need to watch to move on to the much more important parts of trading. And a lot of the information you hear here is going to be probably different to the generic stuff influencers tell you on social media. Good, because you do not need another influencer telling you that trading is easy, trading is a quick way to get rich. You've probably heard 100 times that 90% of traders lose money. But what have you done with that piece of information? What do you do that is different to 90% of people out there watching the same YouTube videos, doing the same things over and over, and just losing money to a gambling addiction? So I'm going to spend this entire video, as long as it takes, to give you all the information you need. I want you to avoid every mistake I made. I want you to avoid the common traps that new traders fall into because of all the misinformation online. And I want to give you a full technical analysis system that actually works and isn't just an art class on drawing rectangles and lines on a chart. If that sounds good, just get out a notepad, put away distractions, and give me your attention for this video. I will not waste a second of it. So let's start here. If you take a look, this is a roadmap, a 5-level roadmap that I created that talks about the trading journey, common mistakes people make. Step 1, which I just spoke about a bit, was the first one where people just decide to trade for the wrong reasons, to get rich fast, and they end up getting poor fast and losing a bunch of money. But if you start trading for the right reasons, which is freedom, work with who you want, whenever you want, wherever you want. That's awesome. That's amazing. And it's a great thing to strive for. Also, there's a high income ceiling. You get good at this game, you can make a lot of money, but the key thing is get good at this game, which takes time and effort. So now we're doing it for the right reasons. The next mistake people make is watch a couple YouTube videos and start trading. No, it takes time, a lot of time to start trading. Watching a couple YouTube videos and starting to trade is like watching one video on how to play poker, then going to a high stakes poker table and betting serious amounts of money expecting to win. It's not going to happen, but we can start by building a solid foundation. The foundation requires 3 things: risk, edge, and journaling. Today we're going to talk about edge, and the edge that I choose is technical analysis, which applied correctly can result in a great edge. I'll explain exactly how to do that in this video. See, first you need to understand where people go wrong with technical analysis so you can avoid it. This is the most common trap. Trying to end up with charts that look like this. There's a lot of different technical analysis strategies. I'm going to explain every single one and tell you which are good and bad, but this is most people's goals. I want to get a chart with loads of lines, fancy strategies that is pretty much astrology for dudes. It doesn't work. I've never seen anyone make money because their chart is complicated. And in fact, most of the best traders I know have very clean, simple charts with limited variables. And I'll explain how you can get the same charts as them. This does not work. It's hard to stay consistent. It's hard to make sense of any of it or express any ideas clearly onto the market. The next common trap that people fall into is this. Now, these cookie cutter cheat sheets have some use. They can help a little bit in finding common patterns, and there is meanings to some of these, like this is pretty much a structural level, price going sideways, and then a potential trend reversal. It makes sense, but I know people that will short here. I know people that will long there. The nuance is everything, and cheat sheet charts like this remove all nuance and therefore are entirely useless, because if they worked by themselves, how freaking easy is it going to be to code this? You can code all of this into an algo and then have the algo trade. If the algo could make money off of this, do you think someone isn't doing it already? Like, it's not difficult at all. So if an algo can do it, then you're not going to make money with it. And if you want to, go make algos, go get into algo trading. That's not what I teach. I teach manual discretional trading, and we'll explain how to build our edge there. So the next thing I want to go into, the next trap I don't want you guys to fall for, are signals groups and paid indicators. Neither of these work. Signals are an absolute joke. I've interviewed 100+ millionaires in private and publicly, and not one of these traders have ever made their fortune through following signals or buying some paid indicator. Both of these are useless and don't make any sense whatsoever. Signals groups, like if your signals were making money, you just trade them. Why would you give them to other people and make the trade more crowded for yourself? Makes no sense whatsoever. Next, paid indicators are scams. If your indicators worked, you'd make an algo. The exact same logic as these patterns. If this indicator that you're selling to people made money in isolation, you just make it into an algo. But it doesn't work in isolation, therefore it is useless to most people. So the big money indicator that tells you, hey, buy here, sell here, buy here, sell here. Why wouldn't they just code that into an algorithm? It doesn't make sense. It does not work. It is a complete waste of money. Now, I'm not hating on all paid products. I mean, personally, I've made free courses. Some people charge for courses. They can be good. You can have great trading courses. And if you trust the resource, you resonate with the guy selling the course, sweet, go buy it. And I hope it helps you. But what I don't want you to ever buy are paid indicators or signals groups. Both of these are entirely useless and will not serve you. Okay, so what do you do now? What actually does work? Well, you see, technical analysis needs two things to work. Firstly, it needs to be consistent. That means every single time you pull up your chart and you do your analysis, you do the same thing. It's not just random lines. And then the next thing you need is some sort of belief about the market that your TA helps you express. So when you have an idea about what's going to happen, you can use your TA to formulate a trade. And that is it. That's all technical analysis needs to do. So let's look through some technical analysis techniques. You can use Elliott wave, supply and demand, Ichimoku cloud, just price action and volume, smoke signals. It really doesn't matter which one you use, but there's pros and cons to every single one. For example, Elliott wave is complicated as hell. There is so much you need to study and learn, and it's not more effective than any other strategy or technique. So why would you spend all this time studying Elliott wave when you can get a much simpler system together? Smoke signals, for example. What's the problem with smoke signals? Sure, they can be consistent. You can trade the same smoke signals every single time, but they have zero ability to express ideas onto the market because they're completely disconnected to the market. So whatever technique you want to use, weigh it up in terms of, is it consistent? Does it help you express ideas about the market? If it ticks both of these boxes, it's applicable. But I still think there's a better way to do this. These are not all created equal. Once you dispel the belief that complexity in technical analysis is superior, you realize that simplicity actually makes consistency easier while also making the learning curve shorter, and it even makes the ideas easier to express onto the market. So I optimize for zero complexity. I avoid as much as I can complexity in my trading because it does not serve me, it does not help me make more money. I like to keep things as simple as humanly possible and only add complexity when absolutely necessary. This is why I say if I had 6 months to learn trading, I would only spend 2 to 3 weeks on technical analysis because I want the most simple system possible and I can always add complexity later. I can learn more complex indicators or tools when I have a reason to. So what I'm about to teach you guys is a system that you can learn very quickly, a system that I've used for the last 7 years and that you can start applying to the markets by the end of this video. So let's get started. Firstly, what is price action? This is the movement of price plotted over time. We use past data to make predictions about an uncertain future. This is with tools like support and resistance, patterns, trends, etc., all the strategies we just spoke about. Technical analysis is the study and analysis of this price action. I'm going to go quickly over the basics. The tools we use are candles like this. This one goes down, this one goes up. Price starts here and ends here. Each candle represents a time interval. This can be anything as low as the 1 second chart all the way up to the 1 month, 1 year chart. And if you take a look, here's an hour chart. This hour chart is comprised of 4 15-minute candles. So 4 15-minute candles are 1 1-hour candle. This is how you zoom in and out of different time frames. So which time frame should you use? Which time frame is best for you? Well, here I've got definitions of different time frames. Intraday traders tend to be below the 4-hour. Day traders tend to be between 1 hour, 1 day, and then long-term traders between the 1 day and the 1 month. But it doesn't really matter at all. You can use any combination of time frames that you like. The only recommendation I have that I strongly stand by is that if you're a new trader, start on the lower time frames as low as the 1 minute. Why? Because one of the most important things for you to develop is going to be experience. The best way to develop experience is on the lower time frames because you get a ton more data, a ton more trade opportunities to take. Whereas if you start on the 1 week, you're going to be taking a few trades a year. That's not going to help you learn or grow as a trader. So now my background is actually in statistics. That's what I studied. That's what I absolutely loved. And I like to bring a few very basic, super simple concepts of data analysis into my technical analysis. So always remember these things as you're analyzing charts. Firstly, context. Always keep the big picture in mind. Data in isolation is not useful. Secondly, sample size. The more data tells you something, the more likely it is to be true. If you have only 2 things telling you something, it's much less valuable than 100 things telling you something. Next, quality. All data is not equal. Learn to identify what is an outlier and not part of the larger picture. Lastly, keep it simple. Complex does not mean better. So let's start with one of my most popular concepts, the one I get the best feedback on from traders. And this is using an analogy that I came up with in order to not need chart patterns ever and understand what's happening with price data based on the bull and bear army analogy. So I'll go back to an old clip of mine that'll explain this for you guys.
So I want you to imagine a meter where on one end we have the bears winning the war, and on the other end we have the bulls winning the war. Every time you look at a chart, this battle is constantly ongoing, and we're going to move our bias across this meter. If we're really bearish because it looks like the bears are winning the war, we're going to be more bearish and lower on the meter. If we're really bullish, like the bulls are going to win the war, then we're going to be closer to the bull side. We're going to take that bull and bear meter right now and apply it to the chart and help interpret what is happening in the market using absolutely nothing but candles, maybe a little bit extra here and there, but I'll try to keep that to a minimum. So right now you can see at the start over here in actually April 19, price is going up aggressively, doing really well. And then over here, look at these giant wicks. What does this represent? These are fallen bull soldiers, a bunch of bull soldiers falling and losing this battle. Now take a look at relative size as well. Look at the size of this wick and the size of all the previous candles. It's just as big, if not bigger than those. Therefore, that represents a huge win for the bears. And right here is when the tides of the battle change. And you can see the bears start winning all of these movements into bull territory. Take a look over here. You've got the bulls trying to get back up, but in these 2 candles, they can barely get back all of this lost ground in the previous candles. And over here again, bears are winning, pathetic attempt by the bulls, and bears continue to win. If you take a look at the chart, this continues to happen as it goes back down. You can see bulls do one big push up over here, and they're starting to try regain their ground. But the thing is, look at this, 2 bull candles over here, barely trying to fill up this one bear candle. So right now, bulls still look extremely weak. If you zoom into the micro, just this period here, they're starting to look okay, but every attempt up is still being aggressively sold down. At this point, when you see this one big candle come up over here, that is when the tides of the battle are starting to change a little bit. Because not only have we defeated this bear candle over here, but in one candle, we've taken out this one over here as well. We've had a bit of a rejection, but prices come back up again. Now the final big candle that we want to defeat is right over here, because look, this whole thing is that one huge bear move down. Once we get above here, the bulls have made it, and they've got a lot of free territory to gain back. Here we can see it's going sideways, but we remain relatively bullish because look, even though the price is going sideways and not still up, after all this period with the bears barely being able to do anything, right now the bulls are holding their own. They're not giving up any ground to the bears outside of wicks as they attempt to break this area here. And look, we're using absolutely nothing but the candles over here to figure this out. You can see this area over here, the bulls are really struggling to get above. And then in one fell swoop, you can see the price gets above this area over here. And that signifies a huge victory for the bulls, and you can see following bullish candles. Now, a lot of people over here like to think it's too late to buy. I often say buy high, sell higher is a very viable strategy in crypto, and that's because when you take a look at this analogy, you can see the bulls are winning the war. Why would you bet against people who are clearly winning the war with no signs of losing whatsoever? Now let's keep watching the chart. Here, the tides shift a little bit. We see one big victory from the bears over here as the price comes back down. But it's not quite enough because look, it's now 10th of August 2020. Since the 16th of March 2020. The price has been going up non-stop. The bears need to do more than this. They need to at least overtake this big move up here by the bulls. And in no time at all, the bulls regain control of this war. And you can see, why would you bet against the winning side? Non-stop, the bulls are winning. This is why in crypto you buy high, you sell higher, because the price just does not stop when it starts. However, over here you can see this first big sign of resistance, because after ages of only the bulls winning, the bears finally showed a little bit of strength. Now this isn't enough to turn bearish, but I would be cautious here because the other army's shown a little bit of strength. Hopefully you can see how simple and effective this strategy is, just imagining a war going on and you trying to gauge what's going on in that war. Here, a few more candles, the price comes back down, the bulls try to get back up, it rejects, you have to be careful, but then in one candle, take a look at this. One bull candle has just taken out 1, 2, 3 bearish looking candles. This one's a bit bearish because of this huge wick above of it in one candle. That is a huge sign of strength. And following that huge sign of strength, where one candle has just taken out 3 relatively bearish candles, unsurprisingly, we see more upside and more strength from the bulls. Now, this candle is a lot more scary than this candle. If you've been paying attention to this video, you should be able to tell me why. Remember, relative size. This body has just taken out an entire bull candle by itself. Just like over here, this whole body just took out 2 bear candles. That makes me bullish. This makes me bearish, not cautious. This makes me now bearish. I think the price is either going to go sideways or down. After this candle, it took 2 bull candles for the price to get back up. It goes sideways, it makes it a little bit higher in this push attempt over here, but as you can see, following that, another huge candle here, taking out 2 bull candles, the price goes down. And now how did we detect this early? Just by noticing this one candle over here. That was our first hint that the tides of war were about to change. Price went up a little bit more, but it generally just went sideways and then came back down after. And needless to say, these 2 candles now represent either sideways movement or bearish movement. Again, look at all these fallen soldiers on the battlefield over here. Clearly, it's difficult for the army to get past this area right here. And you can see the tides turn right in this area. So that's going to be it for this example over here. We'll go into so many more strategies, but at the end of the day, simplicity really is key. Just by analyzing the candlesticks closely and seeing what's happening on the chart, you can gauge so much about the market. And I'm definitely going to give you some exercises in today's assignment around this. Now that you've seen me use this in real time, let's break it down into the micro so you can take away a specific template that you can apply to the charts every single time. Start by recapping the key principles of data analysis. Context, always keep the big picture in mind. Sample size, the more high quality data you have, the better. Quality, all data isn't equal. Learn to identify outliers. Keep it simple. Complex doesn't always mean better. Let's start with an example. Take a look at this candle right now. In isolation, this is a very bullish candle. The size of the body is relatively large. The wick in proportion is small. This shows the bull army making a good move into enemy territory, and the bears could barely push them back. Now, let's look at it on a chart where it matters the most. Here we have that exact candle. Now, context. It's a relatively large bullish candle. Relatively large because looking at every candle before it, this is a very big candle. So in context, it is very significant. But we can't use this alone. We need to incorporate the data around it. Look at these candles down here leading up to this big candle over here. All of these are the bulls winning the battle. Bears, it's all going sideways over here. And then you can see continually the bulls won here, the bulls won again here. They lost a little bit here, but then won again here. So the last 1, 2, 3, 4, 5 candles are bullish as well. So we've got one large candle and multiple small candles before supporting our bullish bias. Quality doesn't look like an anomaly. It's a very normal piece of data. And finally, keep it simple. This makes our bias more bullish. Now let's try a slightly more difficult example. Take a look at this candle over here. Now it's got a fancy name, it's called a hammer actually, but that's entirely irrelevant. The incorrect way is to memorize the name and what this pattern means. The correct way is to take a look at this and figure out the significance. You could also argue it's a hanging man, but the whole point is the names do not matter here. What matters is we have a very tiny body, so we can almost entirely ignore the body of the candle here and focus purely on this disproportionately large lower wick. And remember, what does this represent? A whole bunch of fallen soldiers for the bear army. So the bulls have just managed to take out a huge portion of the bear army's forces. Obviously, that is going to be bullish. Now let's look at this on a chart because that changes everything. Here you can see the pattern on the chart. Let's paint the picture. Price is going down. We're in a bit of a downtrend because you can see the bears are winning the battle. Price is going down, going down. Here the bulls have a small victory, but again, they're rejected immediately after. They can't gain any ground after this. It goes sideways for a bit, the battle is neutral, and then the bears make another push. And then here, this huge wick happens and the bulls make one big push up. Now look at this in context. It's a disproportionately large wick relative to the body size, but also the local data. This one wick here is bigger than almost every other candle behind it. So we know that this candle is bullish. But remember, we need to look at the sample size as well. How much data do we have to suggest that this is bullish? Because if you look back, we've got loads of bearish data. Well, it's only one candle, but it's significant. So at this point, what is our bias going to be? Well, keeping it simple, this is bullish, but we need more data. And we do actually get more data in the next few candles. This candle here is a bit of a push up, and this one here is a bit of a rejection. Now these two are a lot smaller than this one big significant piece of data, so they don't change our bias too much. They're a bit of a weak push back up with a bit of rejection off of this point here, where they fail to claim the ground this candle over here gained. But then we've got this second big piece of data over here. Once we get two pieces of data like this is normally a great point to change your bets. So I would have maybe, if I was feeling risky, bought down here, but then when this second candle comes in, I definitely go for a buy, and then I wait for the price to go up, which you can see it steadily does with another big rise over here. And we would have been able to predict that entire move up by first spotting this candle here, and secondly, this big second piece of data over here. Risky over here because the sample size is small, less risky over here because the sample size has gotten bigger.
That is chart patterns done. So now we can move on to understanding support and resistance. I'll jump to a clip to explain this now.
Let's recap support and resistance. What are these levels? Well, support is an area where there is demand or buying interest for an asset. It means price hits that level, people want to buy, therefore price goes up after it comes to that level. Next, we have resistance, which is the opposite. This is where there is supply or selling interest. This is where people are looking to offload their bags. So when price hits this level, it tends to get pushed back down. So in general, these are key areas on the chart where we expect a lot of buying and selling to happen. So what are they? Key levels on the chart where we expect buying or selling to happen. Let's circle back to the example we showed at the start of this video. Here you can see a support level where we expect buying to happen. Every single time price has come to this level, to this area, buying has occurred. This is a very solid support. You can see over here a resistance because every single time price hit this level, selling occurred. So how do we know buying or selling occurred? Because look, price hits this level, it goes up. Price hits this level, it goes up. Price hits this level, it comes back down. Now follow along with me because you'll notice here the price broke this level. These are not guaranteed levels. They are guidelines that help inform our trading decisions. Now in context, I'm going to show you every single thing that can happen at a support or resistance level. Number one, the level holds. Take a look at all these examples where the level has held. Over here, the level held. Why? Because price came down to this level and then pushed back up afterwards. Here, held again at every single one of these levels. Here, the price holds. So at a support, price holds when it hits this level and then bounces back up. At a resistance, the price holds when it hits this level, comes back down. Hits this level, comes back down. Next thing that could happen at these levels is that the price breaks the level. Let's take a look at examples where the price has broken the level. Here, resistance holds, and then it breaks. Price absolutely smashes through it. Again, here's an example of support breaking. Price comes below, goes a little bit back up, and then smashes through it. Here, the support broke again. Price went through. resistance here, broke. These are examples of the level breaking. Now there's one more important scenario that we need to know about, and those are traps. Sometimes the price, like in this instance here, will go just above and make you think it's about to break it and then smash back down under. Take a look at this over here at the 60k resistance. Price goes up, then smashes back down. It makes it look like it's about to break, but then comes straight back down. This here is a perfect example. Notice price goes up with 2 weak candles from the bull army and then smashes back down and breaks. So at these levels, the price can hold, the price can break, or it can set up a trap and then immediately fall back under. I want you to think back to our analogy about the bull and bear armies. Now, the candles represent the soldiers. The wicks represent fallen soldiers, failed attempts to get into enemy territory. Now, support and resistance levels represent walls. Resistance is a wall from the bear army. Support is a wall from the bull army. Using this analogy, it can become very clear intuitively what is happening on the charts and how strong these walls are. Using this army analogy, we can paint a really good picture of what is happening, and it can make data analysis so simple. Now that we've got the basics down, we're going to start evolving our understanding of support and resistance. So support and resistance are interchangeable. If you take a look at these examples over here, you can see that the 40k level at this point was acting as a consistent resistance. But then after it broke and the price came back down, it became a support. Taking the army analogy, this is like the wall being captured by the opposite army. Sometimes the wall gets destroyed so bad that the opposite army can't use it. In those cases, it does not flip. But if it breaks cleanly, comes back down, retests, and the bears or bulls manage to capture it, it will now act in favor of the opposite army. Taking a look at another example, you can see over here, the 60k level was consistently a support, and then it broke, price came back up, tested it, resistance, broke, price came back up again, take a look here, tested it, it was a resistance. So support and resistance are interchangeable. When a support breaks, it can flip into a resistance. When a resistance breaks, it can flip into a support. The next concept that's extremely important, and a lot of beginners get caught out by this, it's not an exact line, it's actually just a general area. We can use some advanced strategies like laddering to make sure we take advantage of this. You'll learn about that later in the course, but for now, take a look. It's not always hitting the exact point. Each of these lines are better represented by areas. The line is just a guideline, so it doesn't matter if you put 40,000, 3950, 4050, like it's really not important the exact level you use. You just need to know that in this general area, this sort of price action is going to happen. And you can see when you treat them as areas, it captures a lot more of the movement and you're prepared for a lot more to happen. And now the final rule, which is really important, is never use this in isolation to buy and sell. You can't just buy because it's a support or just sell because it's a resistance. You need a lot of other factors. You need to take into account the macro trend. You need to use proper risk management. You need to have a tested system. All of these things you'll learn how to use and put them together, but support and resistance can be a huge part of your trading system, but they do need to be a part of a system and not used in isolation. Another point that's actually extremely important is to pay attention to key psychological levels. Notice at the start of the video, every level we placed was a big round number. Now, there are a few different types of levels that will be considered key psychological levels. The first one are nice round numbers. People often like to set themselves targets which feel good. For example, 30,000 Bitcoin, 40,000 Bitcoin, 50,000 Bitcoin, 60,000 Bitcoin. Some of these will be more significant than others. For example, 50,000 is halfway through to 100, so it's going to be a big milestone. Obviously, 100 is going to be so significant because so many people will have bought Bitcoin and said, I want to sell it at 100K. Now, this can change depending on the asset. For example, if we bring up the Ethereum chart right here, $4,000 over here, significant level, resistance, resistance, support. You can see it there. $3,000, exactly the same thing. Notice support, support, deviation, back above. $2,000, exactly the same thing again. Clean resistance, support, 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 deviation, deviation, but still somewhat of a support. These round numbers work on every single asset. Now, there is one other level which is extremely important, not just the round numbers, but specific milestones. Milestones are previous all-time highs. Going back to Bitcoin right now, $68,000 over here is going to be extremely significant. Why? Because this was the highest point the price got to. So breaking that again is all-time highs. Therefore, it's very significant. Also, on this chart, psychologically, $30,000 is going to be really important because it's the most recent support that was held before the price changed its trend. So $30,000 down here is really important because look, it hasn't broken. It's held so many times. So people get emotionally attached to that level. Not only that, but remember, every time this level holds, it means more and more people bought at this level. So if it does end up breaking, it's going to be a huge victory for the bear army. Now we're going to go through a support and resistance analysis process. I'm going to get into the specific details and break down how I think about them. First point of data analysis, sample size. We need to know how many data points we have. The more data points we have, the more established the level becomes. If you take a look here, you can see that this level has held multiple times. At every single data point, the support has shown strength. However, the number alone is not enough because if you take a look over here, we've got 3 separate data points: test, bounce, test, bounce, test, bounce. 2 of these are bullish. One of these actually make the argument weaker, and I'll show you how to figure that out. You figure that out by analyzing the quality of the data points. The first quality point I want you to look out for is if they show strength. Do these levels show strength? And strong or weak are always relative. So if we take a look at this first test here, huge wick up. The army managed to absolutely decimate a whole bunch of bearish soldiers and get back up. Great. Second test, same thing happened. Both of these look really nice over here. Let's zoom in a bit. Okay, now, however, take a look at the second example here. Price came down, but then it barely pushed back up. Whereas previously, it got up to here. This time, it only got up to here. So this test over here shows that the bulls have actually gotten a bit weaker. After testing this level, they couldn't push the price back up as high. Therefore, this data point makes me think, ooh, this wall's getting a bit weaker. The bulls aren't able to push back off after the bears try and break the wall. So this argument makes me think it gets a bit weaker. And then here, we have a huge bounce off of it. So makes the argument stronger again. Let's take a look at our other data points. Here, huge bounce. Here, huge bounce. So all of these make me think that this level still remains extremely strong. Now let me show you an example of a level with lots of data points that's actually pretty weak. Over here, the 60K level. Here, the 60K level, first data point. Price went up and down, didn't really touch the level cleanly. It actually got a close and then came down slowly afterwards. Here again, we had another deviation. The level wasn't really expected. We had a bit of a trap over here. Price went above, came back down. This does not look like a really strong wall to me because the army, every time it tries to break through it, it does. And that's why after those 2 tests, and maybe here we barely got up to it, price went up here, tested it as a support. Even when testing it as a support, we had a break like this, went back above and came back down. This level is not very high quality. There's lots of choppiness, people going back and forth between the wall. We've still seen some signs that it's relevant, but if you compare it to this 30K level over here that looks extremely strong, extremely clean, you can see huge differences between them. Cleaning up the chart a little bit, let's take a look at the 40K level. This one, clean data point there, another clean one, a break, price comes back down, lots of clean data points here, a slight deviation there, and again, a very clean data point there. This sort of price action, again, indicates a more significant, a stronger level relative to the 60K, which just doesn't get respected as much. So you need to take into account all this information to get an idea of how strong these levels are. So what other factors matter for the quality of data points? Another one is recency. I've seen even advanced traders ignore this fundamental principle. The more recent price data is, the more accurate a representation of the current market it gives you. Because if something happened a year ago, it's less likely to represent the current participants of the market than something that happened 1 month ago. And how do we use this in practice? It means when we're determining the strength of a level, I'm going to put more emphasis on and give more value to the stuff that happens more recently. If something happened back here during this bit of price action, it's going to be less important than something that happened over here during this bit of price action. Something that advanced and beginner traders alike avoid. Is the macro trend bullish or bearish? If the trend is bullish, then the bulls are going to be stronger than the bears. Resistance is more likely to break, support is more likely to hold. If the bears are winning, then resistance is more likely to hold and support is more likely to break. Take a look at this example over here. Now, we haven't in this course yet gone in detail into trend analysis. That's to come, in fact, in next week's lesson. But you can take a look over here and notice that support is generally stronger than resistance. Notice this 30K level, it just does not break. Notice when we get above and back onto this 40K level, it broke once here, and then as soon as the price got back above, it held as a support. Notice that our resistances, this 50K level, none of these data points are clean. We smash above it here. When we get above, there's another trap there as the price tries to go above. Without many attempts, we get back above it again. This 60K level, continually disrespected from a resistance perspective. This is because we are in a bullish trend here. The supports are more likely to hold, the resistances are more likely to break. In a bear trend, it is the opposite.
The last essential thing to cover before we go on to putting it all together in a system is trends. And for this one, I'll do a live lesson right now and explain how I look at this and how you can do the same. So let's make me a bit smaller, focus on the charts. Okay, so the first concept we'll cover is the different types of markets. There's two ways to look at this, a basic way and a way I prefer, which is a little bit more complicated. The basic way is up, down, sideways. Those are the three different types of market conditions. And then something I found more helpful for my trading is adding a volatile metric. So you say up, up volatile, down, sideways, sideways volatile. So this is how I like to view things. If you prefer something a bit more basic, you can start with up, down, sideways, and then move on to this. So how do we look at trend? There's an essential tool, and then there's two assistance tools that I like to use, which will be the only indicators I add during this technical analysis course today. So what's an uptrend? Literally just a series of higher highs and higher lows. This is a high, this is a low. This high is higher than this high, therefore it's a higher high. And this one, and this one, and this one, and then continually price goes up like that. That is a basic uptrend. Next, we can start getting some sideways consolidation, where price enters sideways trend. So this is where we keep hitting the same levels again and again, and we're going sideways. And then, as you've guessed, a downtrend is just going to be the same as an uptrend, but in reverse. So this is where we enter a downtrend. So let's swap over to the 1 day and then clear this up, zoom in and take a look at the trends. Actually go to the 1 week. So I want to take a bigger picture look here. So we've got a downtrend over here. You can see a progressive series of highs and lows, and then it swaps over to an uptrend over here by a progressive series of higher highs and higher lows. So that's the uptrend, that's the downtrend, and that's the basic format you use in order to determine and what trend the market is in now. I'll show you a tool which could make this a lot simpler, but before I do that, there are a few key things that can happen in a trend. So the first thing is a trend reverses. So a reversal begins when we break previous key level. So if we just take a look over here, let's circle back to the previous bottom over here. Now, if we zoom in, we can actually add a couple more levels. Go over to the 3 day so we get a bit more detail. We're consolidating over here and we've got a high over there. And then if we pay attention to the price action, the key things we want to watch here are when do levels break? And one of my favorite ways to trade is not when we're going sideways like this, but when levels end up breaking. And I actually traded this entire move here, shared my thoughts live on exactly what I thought was happening. So if you've been following me for a while, you're very familiar with this. But take a look. Key structural levels broken, prices exploding. This is the start of a trend reversal. And every single time one of these levels breaks, the probability of the reversal being legit and continuing increases. And the whole analysis is just watching these, creating a new high and a new low. And every time a new low or high is created, you want to wait for it to break. This was a fake break over here. Here, we're hitting into new resistance. As you can see, price is going up, new resistance goes down, forms some sort of base, and then you just watch. Sometimes the base breaks, and you need to see if the trend's about to reverse. But same here, fake out, fake out. This is the same resistance over here, continuing. Here, the range expanded a little bit, which I'll add. Sometimes you can see that this level here isn't being respected, therefore the range expands and goes over here. Price continues, another breakout, And this is basically how the trends work. So I've got a much more detailed lesson going into trend analysis, but these are the key principles you need to understand right now. There's only 2 tools that I will use in order to help with my trend analysis. The first one is moving averages, and it's so simple to look at trends with this. Let's go to the 1 day so we can get a clearer picture here. If the moving averages are crisscrossing, then it is a sideways trend. If the moving averages are fanning out, it's an uptrend. If the moving averages are fanning out downwards, it is a downtrend. That's it. That's all you need to do to use moving averages to help. But bear in mind, moving averages are a little bit delayed, so they don't quite tell you when this has started. For example, here, you can see that the sideways trend has started, but the moving averages don't fully kick in till about halfway through the trend. So know that these are delayed indicators and only help you visualize the price data. They don't instantly tell you what's happening. They're just a tool to help you. The one other tool I like to use is Fibonacci, and I use this so simply. Let me add a few more. This is just a ruler that measures the strength of a move. That's all it does for me. So when I take a look at this move over here, I start from the bottom of the previous move up to the top. And how far down we retrace tells me the strength of the move. If the buyers are really strong, we won't go down past the 0.236. If we go to the 0.382, the buyers aren't as strong. And again, and again, and again. The lower we go, the weaker the buyers are, the weaker the current move in the trend is. And that's a turbo lesson on trend analysis. I'll explain it in a bit more detail as I put all the tools I've just given you together.
Now, finally, the moment we've all been waiting for, putting together everything we've learned for a step-by-step analysis process. Step 1, establish the trend. We're going to start by looking at market structure. We're going to use Bitcoin. For the market structure, I'll stick to the higher time frame, which is the 1 day in our case. We'll mark out the key levels that we want to be watching. You can see from these key levels over here that we had a clear uptrend over here, and then it peaked out, started to go sideways, and swapped into a downtrend when this key structural level and this key structural level broke. Next, for confirmation, let's get our moving averages onto the chart. And you can see that the moving averages agree with our analysis. Strong uptrend, started to go sideways. You can see these 2 moving averages getting closer together, and then completely reversed over here and started the downtrend. Next, we're going to use 2 more tools discretionarily: Fibonacci levels and candlestick patterns. We can use Fibonacci levels to determine the strength of different moves, especially key moves. We'll clean up the chart right now. Let's get the Fibonacci level. We'll take it from up here, the top of this move, our first lower high for a while, and take it down to the current bottom of this move. And what are the key levels that you can see over here? This 0.382 resistance right here at 40K. So also what I like to do at this moment is double click on the Fibonacci levels and get rid of everything else that I don't quite want to pay attention to right now. So this 382 level is going to be the most important one for me right now. What does this mean? That this is actually quite a strong move down until we reclaim the 0.382 level. As it stands right now, this does not look very good for the bulls. Finally, we're going to do some candlestick analysis. If we zoom in here and take a look, I can see that the bulls are really winning the war over here. This down move over here is extremely one-sided, but in this phase of the market, it's a little less one-sided. It's cooled down a little bit. The war is consolidating. It is not as aggressive in one direction or another. Congratulations, using just these 4 tools, you have now completed your trend analysis. The next important part of our process is going to be establishing key levels. We start with, of course, support and resistance. So what are the key levels we're paying attention to? Over here, we can see this 40K level, extremely important. Data point here, data point here, data point here. It's got a key structural level there and a key structural level there. It's also psychologically very significant. Down here, another support, very important, 30K, key structural level there, forming a key structural level here. Hasn't been broken for a long time either. Notice how this 40K level has been broken. This one has not been broken, so very strong. Now we'll mark a couple more key levels. Down here, I can see a minorly important structural level just above 20K. I like to keep this level in mind, especially in case this level here breaks. Now I'm going to pay attention to the next key level, which will be up here at around 50K. Notice the multiple data points supporting it. Strong resistance over here, support, small deviation, but it bounced afterwards, and as the price came down, it acted as a resistance there again, as well as a key psychological level. So that's finding the key support and resistance levels. Next, what are the key structural levels? Well, let's bring this here and this over here. You can see these two structural levels have just lined up with 40K in the 382. That makes this level even more significant. So let's change the color of this level. We can see two structural levels lining up over here. This is again increasing the significance of this level. Right now, this level has just become hyper important. Not only is it psychologically important, it's also the 382. It's also a key structural level. Similarly, down here, the 30K, you can see it lines up with two key structural levels. That's what makes this level so important, because we could actually take a support over here and make the argument that 32K is a support. Why? Because we can see a lot of wicks bouncing off of it, but that's an isolated argument. It doesn't have as many data points and it doesn't look as clean as the rest of what the chart presents us. Next, we have key psychological levels. We've already spoken about these: 30K, 40K, 50K, 60K, round numbers. Now, key Fibonacci levels and key moving average levels are the last two we're going to analyze. So the key Fibonacci levels over here, we've highlighted the 382 because that's where the moves bounced, but now we want to highlight key levels. Let's bring every single one back on. The 236, I'm analyzing this. I can see it act as a bit of a resistance over here, but I dislike the fact that it gets chopped up so much over here and there's no other data really supporting it. So immediately I'm going to get rid of that. Next, we have the 45K level over here, and I actually really like this level because if we come down to here, highlight it, we can see key structural level lining up, 0.5 lining up. So this is multiple different arguments lining up and making this level significant. So I want to leave that on my chart. You can also start to get rid of data and start cleaning this chart up. Next, the 618 over here. I don't actually love this level. So it's got a little bit of support with this key level over here, but I won't be paying that much attention to it, especially in terms of drawing a key level there, but I'll leave it up on the chart because it's significant. Then we have the 0.786 over here. Again, it gets chopped up quite a bit. I don't see strong data, so it's just going to be noise. I'll take that off the chart as well. Also taking off the rest of these because we now have a clearer picture. Final thing we're going to do is bring in the moving averages. Now, which levels do the moving averages support? This is extremely useful because you can see our 100 moving average is moving up to line up here, because when you look at these moving averages, remember they are lagging. So something you can do is predict where you think it's going to go. Yes, the level's here, but price is not going to do that, go up in a straight line. At least it's not probable that it does that. Sometimes it does, or smash down in a straight line aggressively. Normally, it moves in choppy motions up or choppy motions down. That means that this moving average is going to slowly follow along. So as long as the price stays down here, I expect this moving average to slowly trot along and eventually line up with this 382 level over here, making it very important. So now the most important level on this chart is this 382 level over here, because so many different arguments line up with it. The second most important level on this chart is the 30K level over here. Trend analyzed, key levels marked out. Now we're going to start establishing scenarios, how we think the market's going to play out, and these hypotheses are going to be the foundation of our trading systems that actually start making us money in the markets. There's 100 different ways to skin this cat, but as always, I'm going to make it so simple for everyone watching this video. Firstly, what are the conditions for a neutral case? So right now, I want to look at a neutral case, a neutral market. What's a neutral market? It's when it's going sideways. So what would have to happen for this to stay a sideways market? Well, first, I want to see this level over here hold. So if this level holds and we get a bounce, what would be a strong bounce? Because if this level holds, but we only bounce to like, say, here, then that doesn't support the neutral case because it probably is going to continue going downwards. So I need to think, how high do I need this to bounce for it to at least hold a neutral case? Well, price goes up to, say, this midpoint over here, maybe comes down, goes back up, starts going sideways, stays between 40K and 30K. That's my neutral case. Now, I am a trend trader. You'll learn more about trading styles later in this course. So I don't care too much about the neutral case, but I need to know when it is, because as long as it keeps bouncing between these levels, I don't need to trade. Now, what are the conditions for a bear case? Let's think of the bearish scenario. This is going to be a lot easier because all it needs to do is break this 30K level. That's it. Don't overcomplicate it. If it breaks this 30K level with conviction, if we can zoom in to say the 4-hour time frames, we take a look and this continues to go down and we can't at least Ameeta's claim on the 4 hour, this moving average here, this is the bear case. This right now looks terrible. As long as we stay below this 100 moving average on the 4 hour, I will assume the bear case is intact. So what are our conditions? I can set a simple one like this moving average over here, or you can set a different one for yourself. You could zoom into the 4 hour and be like, I like this key structural level over here. They're very similar. Whatever it is, you need to have your conditions. These are going to be mine for this. And finally, what are the conditions for our bull case? Over here, because the macro is bear, we need a significant shift to consider the bull case. The trend right now is going down. We're right next to our lowest key level. So this is the neutral case. My key level for us to go neutral again is 36K. My key condition for us to go bullish again is 40K. Until we break convincingly this 40K level, I'm not really going to turn bullish. So that's our analysis complete. Key bear condition, staying below the 4 hour 100 moving average. Key bullish condition, claiming the $40,000 level on the 1 day over here. Key neutral condition, claiming the $36,000 level on the 1 day over here. Now I'm going to show you the power of our analysis. Take a look at what happens in the market. We bounce off of this level over here, and we don't actually need to do any more analysis right now. We're just going to watch the price action unfold. We're bouncing, price is going up, it's testing this level here, no resistance, got above, and let's pause over here. We just smashed through the 36K. Look at the power and conviction at which our neutral condition was just claimed. And remember, we predicted the path of this moving average. It went exactly where we predicted it to go and acted as a resistance over there. So as you can see over here, we've claimed the 36K and our neutral condition has been validated. So now let's zoom into the 4 hour and take a look at what's happened exactly. Our bearish condition was invalidated. As we can see over here, we did not stay below this key moving average. And in fact, the second we broke above this, the entire trend reversed. Let's quickly analyze this move over here. We can see a 382 level retracement. So that's a very strong move leading straight into this 40K resistance. That 382 level also happens to line up with 36K. Let's move back to the 1 day. And all I've done is add one more level, this 382 that I'm going to pay attention to. Let's watch what happens next. Price goes up, it's testing this 40K level, still testing, struggling a little, and we got our first break. This is a 1 day claim of the 40K level. And just like that, our analysis has switched from completely bearish to completely bullish, and we've managed to watch the entire thing unfold non-stop. Now I'm just going to play out the price action, and you'll see without any further analysis how it interacts with our key levels, how everything we marked out hold up and play a significant role in this entire move. Notice how it interacts with the key levels that we set from ages ago over here. Hits it, hits a resistance there. Do you guys see the power of complete, concise analysis done with clear ideas and hypotheses that you adhere to? Every bounce, every move up, every key breakout adheres to one of the levels that we've marked out. Even when the price comes back down all the way here, after over a month, still abiding by every level that we marked out. The final point I'll make is, at this point here, where the 50K level broke, we would have done a new analysis, a fresh analysis, marking out key levels with the price could have gone to as it went up there. You now have a complete analysis system good enough to make serious money in the markets.
So that's a complete technical analysis system that you can learn very quickly and start applying very quickly. But remember, we go back to the roadmap we had at the start. That is just one subsection of one level of learning to trade that you've covered. It's not going to make you profitable. There's a lot more work that we need to do in order to get you there. I've got a Telegram link in the description below, which has access to free courses. If you want to apply to work with me and my team, there's also a link to that in the description below. We work personally with every student, so we can't take on that many. But if you don't get on, there's plenty of free courses, and I'm going to continue releasing material that will benefit you and help you get to your trading goals. That's everything for this video.